So in this segment, we're going to be talking about how Amsterdam has become a trading hub for shares and stuff above London. So this is not great, to be honest with you, because the UK is going to lose out on some money here through things like capital gains tax, etc. Um, and yeah, it's not looking good for London. Let's put it that way. The city of London. So Amsterdam surpassed London as Europe's largest share trading centre last month, as the Netherlands scooped up business a loss by the UK since Brexit. So the Netherlands have done really well out of Brexit because a lot of industries and services and stuff have moved there because it's low tax. And the Dutch, when I went there, at least when I went to Amsterdam, their English as second language is outstanding. So the language barrier would be less existent over there. So it's good. It's good for the Dutch. Their COVID response has been pretty bad, but overall, when I went there, it was very pleasant and everyone was really nice. And fair play to them. Fair play to them. There's a lot of issues within that country, but just like the UK, there are issues in every country. So fair play to the Dutch here. I'm not gonna get mad at them because they took advantage of Britain's mistakes, and so respect. So an average 9.2 billion shares a day were traded on Euronext Amsterdam and the Dutch arm of CBOD Europe and Turquoise in January, a more than fourfold increase from December. The surge came as volumes in London fell sharply to 8.6 billion, dislodging the UK from its historic position as the main hub for the European market, according to data from the CBOE Europe. So basically, these are European shares for European companies, as far as I can tell. And so, yeah, not great for London. And I think this trend will continue. This is something we'll keep an eye on. FT, permitting me and not hitting me with the paywalls. As long as that doesn't happen, and we can keep up to date with it, then we'll keep up to date with it. So the shift was prompted by a ban on EU-based financial institutions trading in London because Brussels has not recognised UK exchanges and trading venues as having the same supervisory status on its own. That's something we'll be talking about in a few minutes. Without this so-called equivalence to ease cross-border dealing, there was an immediate shift of 6.5 billion euros of deals to the EU when Brexit transition period concluded at the end of last year. So you can see a lot of money being moved essentially, and a lot less trade being done in the UK because of the lack of equivalence. It was about half of the amount of business that London banks and brokers would normally handle. Analysts and executives say the transfer would further not mean thousands of jobs leaving, while the tax would be hit. So analysts and executives say the transfer would not mean thousands of jobs leaving. So this is not the worst thing for workers within the UK, but the tax hit would be limited to the effects of move in trade would have on the profits of companies involved. So basically, the businesses that are doing the trade, the money that they would have made in the UK, that tax money is gone essentially. So jobs haven't been impacted as much, but the stock market and sort of the money the government makes off the stock market has taken a hit. Financial services contributed almost £76 billion worth of tax receipts to the UK Treasury last year. So, I do this stuff to the best of my ability. If I'm wrong in any way, if there are any corrections, feel free to comment. I'm not going to give you any flack for saying you're wrong on this point. I would never, I wouldn't do that to people unless I thought you were a bad faith actor. So if we actually look at what's going on here, so we look at Amsterdam, so the dark blue bars here are December and the light blue bars are January. So we can see Amsterdam, not doing that great. You got 2 billion, so average daily billions euros worth of trade. So you can see average trade is about 2 billion a day, all right? In December, you can see that shot up in January to about 8.5 billion. All right, so the UK was about 14 and a half. So wait, 14 and a half would be about maybe 13 billion because it goes up in twos. My graph reading skills are phenomenal as always. So say 13 billion there. That's gone down to about 8.5 billion, right? Yeah, say 8.5 billion, right? So we can see here there's a massive drop by about not half, but not far off half. So you can see a massive drop in shares being traded in, from European companies. All right. What else can we see? We can see Paris gaining ground. A lot of people thought Paris would be the ones to gain the most ground on the UK. Paris have done well. Their shares, the shares traded has gone up by about a billion. No, what's that? About two billion daily average shares traded. Frankfurt's gone up, not by much to be fair, and Milan have gone up a bit. So, Milan would be an interesting one to see if that trend goes up, if it keeps going. What we can definitely see is that Amsterdam have done really well out of this, to the point where they do more trading of European shares than London is. And, this could be just a good month. This could be just a lot of companies flocking to the Amsterdam kind of stock exchange. And then they may filter into other stock exchanges, or this may be the new norm for Amsterdam. So congratulations to Holland. It's a symbol. So, quote from the article, it's symbolic in that London has lost its status as the home of EU share trading, but it has a chance to carve out its own niche on trading, said Anish Puar, a market structure analyst at Rosenblatt Securities in London. Fund managers will be more concerned with availability of liquidity and the cost of placing a trade rather than whether an order is executed in London or Amsterdam. So, these are, market speak. So the availability of liquidity / liquid cash, I guess, of how much they can invest, and the cost of placing a trade. So how much is it going to cost them to actually, put in a trade? So, buy or sell stock, rather than whether that's executed in London, Amsterdam. So location isn't the issue, according to this guy, but clearly it is for some people. That's why Amsterdam are clearly doing better, because of the fact that the UK don't have regulatory alignment. So there's more red tape in the way for the UK to do trades within European stocks. For European stocks, Paris and Dublin also had small increases in business last month, as trading funneled through the EU arms of Aquase and Liquidnet respectively, rather than through London. In response, London has lifted a prohibition on trading Swiss stocks such as Nestle and Roche, which is currently banned on EU exchanges. So this is the UK effectively hitting back here and allowing certain Swiss companies for their stocks to be exchanged, which is great for those two Swiss companies. Still, the large move in share trading to Amsterdam makes the city one of the early winners from Brexit since the start of the year. Amsterdam has also picked up activity in swaps and sovereign debt markets that would typically have taken place before Brexit. CBOE Europe is setting up derivatives trading business in the Dutch capital in the first half of the year. US-based Intercontinental Exchange is also planning to move the 1 billion a day carbon emissions trading market to the Netherlands, although clearing will remain in London. So you can see a lot of stuff is moving to Amsterdam. A lot of trading plans are moving to Amsterdam because that's where it's at now. It's low tax, the language barrier isn't there as much, and they have access to the EU markets. The UK doesn't. EU share trading could return to London as part of discussions between the UK and the bloc on financial services. The thing is, right, because there's so much kind of friction between the UK and EU, that even if we did manage to get some equivalence for now, if the EU started changing the rules on share trading and things like that, then if the UK doesn't follow suit, then that friction comes back. So what is safer for a lot of these investors and stuff is to just move to an EU-based stock exchange, because that kind of stability will always be there within the EU. Rules may change, but at least they won't have to worry about friction between two kind of different entities, if that makes sense. Hope that makes sense. Andrew Bailey, Governor of the Bank of England, repeated his view on Wednesday, that the EU was making a mistake in not granting UK financial services equivalent status in most areas, and in his view, seeking to cut the UK out of the European financial business, leading to the fragmentation of the markets. This is kind of Andrew Bailey, the Governor of the Bank of England, is showing a threat here, which this is not that strong of a threat. Let's be real now. He has regularly called for the bloc to recognise the similarity of the UK's financial regulations to the EU and grant equivalency widely, as it has already in few areas such as central clearing and settlement on temporary basis. The governor complained that the problem with the EU's demands was that it wanted to know how the UK intended to change its regulations in the future as part of the process of granting equivalency, which London has been resisting. I mean, this is not a big EU demand here, is it? Andrew Bailey, the EU want to know that where are you going to go with regulations in the future, and the UK were like, why do you want to know? And the EU were like, because we want you guys to have the same standards as us, and the UK are like, well, we're not telling you, and the EU are like, all right, cool, we're not going to give you equivalence, and the UK are like, how dare you, EU, how dare you, do you know who we are? 2 world wars and 1 World Cup. Like, Germany, you won like more World Cups than us, like. How dare you, EU? This is pretty embarrassing from Andrew Bailey. If this is the best you got, you should have just stayed at home, mate. You should have got the former governor of the Bank of England. He would have made better arguments. Because this is. I've got secondhand embarrassment from this one. Andrew Bailey's argument. The fragmentation of markets, the EU will get over that. They're a bigger entity than us. It's going to be much more difficult for us to kind of get involved in that sort of stuff without equivalency. But Andrew Bailey, your argument here is awful. I'll give you a D minus for that argument. This is standard that the EU holds no other country to, and would, I suspect, not agree to be held itself. It is hard to see beyond 1 or 2 ways of interpreting the statement, neither of which stands up to much scrutiny, Bailey said. I mean, again, he's making a fool of himself here, because the EU are simply asking, he's saying the EU demands. It wants to know how the UK intended to change its regulations in future. What if the UK is going to follow a massive amount of deregulation? And say the EU grant equivalency now, and the UK start deregulating, and then the EU are like, you're not equivalent because you're deregulating, and the UK are like, no, you've already given us equivalency, you can't take back, no take backs. What kind of a stupid, bruv, this guy, he's actually annoyed me now. This is a stupid argument. So now we go to someone else, Mujtaba Rahman, managing director for Europe at the Eurasia Political Risk Consultancy, said the discussion would focus on the circumstances in which regulators would interact with each other. The government isn't really interested in equivalence because it believes the financial sector will be better and more effectively regulated by the Treasury and Bank of England rather than Brussels, he said. And if that's the case, fine. But if we do follow a policy of deregulation, then the EU has every right to not grant equivalency, because that's the whole point of granting equivalencies, to say that, okay, we both have similar or the same rules, you can carry on trading over here, there are no issues, rather than if we followed a rampant amount of deregulation and caused all sorts of issues within the financial sector, a Singapore on the Thames. The EU would have every right to say that we don't see the equivalency here, get lost. So again, the UK making it very hard to defend itself. Again, I find it very hard to defend the UK on a lot of things because of the stupidity of the people within the UK. The stupidity of the people in charge. We can see here that, he talks about, you got numbers here, like we've just covered, the Bank of England chief has warned the EU not to cut off London. If it's the case that the EU want us to have equivalency and we're saying no, and then we're saying you're cutting us out, we are cutting ourselves out here. That's what's happening. We are cutting ourselves out through deregulation. So both sides are working towards a March deadline to agree an equivalence regime under which the UK and Europe would recognise the other's regulation. So, we've got to the end of March, so we're halfway through February, still got a month and a half to figure things out. And, the UK have got a month and a half to figure out what direction are we going in when it comes to regulation. Are we going to keep to EU standards and new laws, or are we going to deregulate, or are we going to stay where we are? There's your 3 options. Boom, do something. Number 10 said it remained open to discussions with the EU on the equivalence issue, despite the fact that we've supplied all the necessary paperwork and are one of the world's most preeminent financial sectors with a strong regulatory system. The EU still haven't granted us full equivalency. This means that some EU shares that were previously traded on UK venues have moved to the EU venues on the advice of the European regulator, but our position is fragmentation of share trading across the financial centres is in no one's interest. I mean, it's not, but if we cannot figure out what direction we are going in, then this is what we deserve, because they are asking us, bro, what are you going to do with rules and regulations in the future? And the UK are like, I'm not telling you. We're the cat that's eaten something, it's got something in her mouth, and we refuse to let the owner take it out. We refuse to actually talk on this issue, and that's what's caused us problems. Simple as, the EU are asking us, what are you going to do with regards to equivalency? UK, bro, we're not going to tell you, that's a secret. Find out next time in the next episode of Brexit, the final venture. The UK goes it alone. This is just really frustrating for me to see. honestly, because it's just, this is so pointless. This is so pointless. What the route the UK are going is pointless, and we're going to lose a lot of money through things like capital gains taxes and any kind of taxes we have on bonuses, and a lot of that money is going to go to EU countries now, to Amsterdam, Paris, Frankfurt, Milan, cities. Sorry, I should say cities. Don't want to be accused of being a complete Neanderthal. You can see how much the UK has lost out when it comes to trading of European shares. You can see it's gone down by almost half, and that trend will continue. I think if the FT do release another article on this next month in March, and we see the trend continuing, we'll cover it. If we don't see any new change, I'll try and cover it. If it goes the opposite way and the UK starts picking up daytime trading of European shares, I'll cover that as well. As long as the FT have got an article on it and I can access it, we're golden. We're golden. And what we can see from this is it's not looking good for UK for UK traders. So I don't know what more to say apart from, if you're a broker in the EU, I hope you've got your English language sorted out, because you're going to get a lot of phone calls, I'm thinking, soon to get these trades done. I don't know what this means for apps either. Any apps that want to trade EU shares. If you're based in the UK, like Trading 212, and I only have that one on my phone, so I don't know any other ones. It's not a sponsorship for them. But I don't know what more to say apart from welcome to Brexit, sir, or ma'am, or whoever I'm speaking to, because this is the reality of the situation right now. We are being cut out, but we are also mainly cutting ourselves out by not offering equivalency. So I'm going to leave it there. Let me know what you think in the comments below, about this stuff. Like, comment, share, subscribe, and hopefully I'll see you in the next one.